Most people think losing money in the market comes from picking the wrong stocks. But often, the real problem is something much quieter. It's the way decisions are made after a stock starts falling, because when prices drop, the instinct feels logical. Something used to cost more. Now it's cheaper. That feels like an opportunity. But in many cases, that instinct is exactly what keeps losses growing. There's a pattern that repeats itself in almost every volatile market. Investors don't lose the most money at the top. They lose it slowly, step by step on the way down. And they often don't realize it until much later. Right now, the market feels uncertain again. Headlines are loud. Narratives are everywhere. War risks, inflation fears, shifting interest rates. It creates a simple story. In people's minds, everything is risky. Everything is falling. Just wait for things to get cheaper. That sounds cautious, even responsible. But that thinking can hide a deeper misunderstanding. Because markets don't move based only on fear. And they don't reward decisions based only on price. Most people believe a simple rule. If a stock was good at 100, it must be even better at 80. That idea feels rational. It feels disciplined. It even sounds like value investing. But there's a hidden assumption inside it. The assumption is that nothing important has changed. And in reality, something often has. A falling price is not just a number. It is information. It reflects new expectations, new risks, or new realities. Sometimes those changes are temporary, but sometimes they are not. And the market tends to recognize that faster than individuals do. This is where a common cycle begins. A stock drops 20%. It looks attractive, so more money goes in. Then it drops another 20%. Now it looks like a bargain. More money follows. At some point, the decision stops being rational. It becomes emotional. The goal quietly shifts, not from making a good investment, but to getting back to even. And that shift is where long-term damage often begins, because now the decision is no longer based on the business. It's based on the price someone paid. This behavior has a name in practice even if people don't call it that. It's chasing losses, and it's one of the most expensive habits in investing. Not because it always fails, but because when it fails, it tends to fail in a way that compounds. A few positions that continue falling can outweigh many that recover. And over time, that imbalance matters more than any single pick. At the same time, there's another behavior happening quietly. Investors avoid stocks that are rising because they feel too late. If something has already gone up, it feels like the opportunity is gone. So instead of looking forward, attention shifts backward to what used to be cheaper, to what has already fallen. But this creates a strange contradiction. People say they want strong businesses, but they often focus on weak price trends. And they avoid strong price trends because they feel uncomfortable. That discomfort is natural. Buying strength feels like paying more. Buying weakness feels like getting a deal. But the market doesn't reward comfort. It rewards alignment with reality. So the real question is not, is this stock cheaper than before? The better question is, what direction is this business actually moving in? Because price alone does not tell the full story. And in many cases, it tells the wrong one. In the next part, we shift the perspective, not to what feels intuitive, but to what tends to work over time. And more importantly, why it works. There is a quiet pattern in markets that often feels counterintuitive. The things that have been working tend to keep working at least for a period of time. And the things that have been struggling often continue to struggle. This isn't about hype. It's about how information spreads. When a business improves, it rarely happens in a single moment. It shows up gradually, first in operations, then in earnings, then in expectations, and only after that in price. Think about how large institutions operate. They don't move in and out of positions overnight. They build exposure over time. That means when a company's outlook improves, the buying doesn't happen all at once. It unfolds across months, and that creates something important. Momentum, not as a buzzword, but as a reflection of sustained interest. On the other side, when a company's outlook weakens, the process works in reverse. Positions are reduced slowly. Confidence fades gradually. New information keeps reinforcing the same direction. So prices don't just fall once. They often drift lower over time. This is where many individual investors get caught off guard, because they treat every price move as temporary. They assume what goes down must come back up. But markets don't operate on symmetry. They operate on probability. And probability tends to follow trends more often than it reverses them instantly. There has been extensive research on this behavior across different time periods, markets, and sectors. One consistent finding appears again and again. Assets that have performed well over the past several months often continue to perform well in the near future, and assets that have underperformed often continue to lag. That does not mean every rising stock will keep rising, and it does not mean every falling stock will keep falling. But it does suggest something important. Direction matters, and ignoring direction can be costly. Now, this idea often creates resistance because it feels like chasing, and chasing feels risky. It feels like arriving late to something that has already happened. But that framing misses a key detail. A rising price is often a result, not the cause. It reflects improving fundamentals, stronger demand, or a shift in expectations. So the real question is not, has this stock already gone up? The better question is, why has it gone up? If the answer is unclear, caution makes sense. But if the answer is tied to real improvements in the business, then the price move may not be the end of the story. It may be the beginning of a longer trend. Consider how new technologies shape markets. When a major shift begins, it doesn't impact one company overnight. It creates layers of opportunity. Infrastructure builds first, then applications, then services. And companies positioned early in those layers often show strength long before the full impact is visible. At the same time, not every company benefits equally. Even within the same industry, outcomes can diverge sharply. Some adapt, some lead, some fall behind. And that divergence is often reflected in price behavior. So instead of grouping everything together, it becomes more useful to observe relative strength, not just whether something is up or down, but how it performs compared to its peers. If an entire sector is struggling, but a few companies are holding steady or rising, that tells you something. It suggests those companies may have advantages, others don't. Stronger positioning, better execution, or simply a clearer path forward. This is a shift in thinking, from asking what is cheap to asking what is proving itself. because over time, the market tends to reward proof more than potential. In the next part, we turn this into a simple framework, not a formula, but a way of thinking that can help filter decisions more clearly. At a high level, there are two very different ways to approach investing decisions. One focuses on price. The other focuses on direction and quality. Most people start with price. It feels concrete, easy to compare, easy to justify. But price alone is incomplete, because a lower price does not automatically mean better value. And a higher price does not automatically mean higher risk. A more durable approach begins with a simple shift. Separate what something costs from what it is becoming. Because markets are not just pricing the present, they are constantly adjusting for the future. There are two practical frameworks that help make this clearer. They are simple, but not always easy to follow. The first is what can be called don't average down without new evidence. Adding to a position simply because the price is lower assumes the original idea is still intact. But that assumption should be tested. Has the business improved, stayed the same, or weakened? Has the industry shifted? Has competition changed the landscape? If nothing has improved, then the lower price may not be an opportunity. It may be a warning. A consistent investor tends to wait for confirmation, not certainty, but evidence. Evidence that the business is stabilizing, or that the original thesis still holds. Without that, adding more capital increases exposure without increasing clarity. The second framework is less intuitive. Respect strength, but question the reason behind it. A rising stock is not automatically a good investment, but it is a signal. It suggests that something is working. The key is to understand what. Is revenue growing in a meaningful way? Are margins improving? Is the company gaining share in its market? Or is the movement driven by short-term excitement? These are very different situations. One reflects durable change. The other reflects temporary attention. One of the most consistent investors in history tends to avoid complexity, not by ignoring data, but by focusing on what is essential. Businesses that generate cash, businesses that can reinvest effectively, businesses that are understandable, and importantly, businesses that continue to perform over time. This is where many decisions become clearer. Instead of trying to predict turning points, the focus shifts to recognizing patterns that are already forming. Instead of asking, where is the bottom? The question becomes, is this business moving in the right direction? That shift reduces the need for precision, because timing the exact bottom is extremely difficult. But identifying a sustained improvement is often more achievable. It also changes how risk is perceived. Buying something simply because it is down can feel safe. But if the underlying situation is deteriorating, the risk is actually increasing. On the other hand, buying something that has already risen can feel risky. But if the underlying business is strengthening, the risk may be more controlled than it appears. This does not eliminate uncertainty. No framework can do that. But it helps align decisions with observable reality instead of assumptions. And over long periods, that alignment matters more than short-term accuracy. Because investing is not about being right once. It's about being consistently less wrong over time. In the next part, we'll ground these ideas in real-world patterns, not to highlight specific opportunities, but to show how these principles tend to appear across different sectors. To make this practical, it helps to step back and look at patterns instead of specific picks. Because the names change, but the structure behind them tends to repeat. Start with a sector under pressure. Take technology, for example. At times, entire segments fall out of favor, not because every company is weak, but because a dominant narrative takes over. Right now, one common narrative is that new technologies will disrupt existing software businesses. That fear spreads quickly. Investors begin to treat the whole group the same way. Strong companies and weak ones get sold together. But underneath that broad movement, something more detailed is happening. Some companies adapt faster. Some already operate in ways that align with the new environment. Others don't. So, while the overall sector may decline, a few companies begin to separate themselves. Their revenues continue to grow. Their products remain relevant. Their position improves relative to competitors. And slowly, their stock prices start behaving differently. This is an important signal, not because it guarantees future performance, but because it shows resilience. When a company performs well in a weak environment, it often suggests underlying strength. A similar pattern appears in cybersecurity. At first glance, it might seem like automation and new technologies reduce the need for protection. But in practice, the opposite often happens. As systems become more complex, the number of vulnerabilities tends to increase. That drives demand for security, not less. So, even when fear affects the broader technology space, certain companies in cybersecurity continue to grow, not because the market is ignoring risk, but because the demand for their services is becoming more essential. Now consider a different type of business: healthcare equipment. This is not a fast-moving, high-excitement sector. It doesn't rely on trends or rapid cycles, but it has a different kind of strength. Demand is steady. People don't pause medical needs because of economic uncertainty. That creates a baseline level of stability. Yet even in stable industries, prices can fall. Sometimes due to short-term concerns, sometimes due to broader market rotation. And again, the same pattern appears. Some companies decline sharply. Others hold up better. The ones that hold up often share certain traits: scale, operational efficiency, consistent demand. They may not grow rapidly, but they convert what they earn into real results. And over time, that consistency becomes visible in both earnings and price behavior. Then there are industries like telecommunications. These are not growth stories in the traditional sense. They are infrastructure, slow-moving, competitive, mature, but also deeply embedded in everyday life. Even when economic conditions change, the core service remains in use. People adjust spending in many areas, but they rarely disconnect from essential communication. So companies in these sectors often show a different kind of pattern: limited growth, but stable cash flow; moderate price movement, but steady returns. And in uncertain periods, that stability can become more attractive. Across all of these examples, one idea remains consistent: the market does not move in a single direction. Even when headlines suggest broad trends, the details underneath are more nuanced. Strong businesses can exist in weak sectors. Weak businesses can exist in strong sectors, and the difference between them is often visible in how they perform relative to their peers. This is why focusing only on what's down or only on what's popular can be misleading. Both approaches miss context. A more grounded approach looks at three layers: the overall market, the sector within that market, and the individual company within that sector. If the market is weak, but a sector is stable, that tells you something. If the sector is weak, but a company is strong, that tells you even more. These are not signals to act immediately. They are signals to understand direction. And direction over time tends to matter more than short-term price levels. In the next part, we address something that is often overlooked because even the most reasonable frameworks have limits, and ignoring those limits can lead to the same mistakes, just in a different form. Even the most sensible approach can become dangerous when applied without balance. Momentum can work. Strong businesses can continue performing. But neither of those ideas is guaranteed. One of the biggest risks is assuming that a trend will continue simply because it has. A rising stock can still reverse. A strong company can still face unexpected pressure. Markets are forward-looking, and sometimes expectations move ahead of reality. When that happens, price can reflect optimism that hasn't fully materialized yet. Growth may slow. Costs may rise. Competition may intensify. And when expectations adjust, prices can correct quickly. This is especially important in areas tied to new technologies. Early success often attracts attention. Attention attracts capital, and capital can push valuations beyond what current fundamentals support. At that point, even a good business can become a poor investment if the price already assumes too much. Another limitation is timing. Even when the long-term direction is correct, short-term movements can be unpredictable. A company may be improving, but its stock can still decline for months. Not because the business is failing, but because sentiment shifts. This creates a difficult situation because it tests patience, and it can make a reasonable decision feel wrong in the short term. There is also concentration risk. When investors follow what is working, they may gradually build large positions in similar types of companies, often without realizing it. For example, several companies may appear different on the surface, but depend on the same underlying trend. If that trend weakens, multiple positions can decline at the same time. This is how diversification can quietly disappear, not by intention, but through overlap. Another risk is misinterpreting strength. Not all upward movement reflects durable improvement. Some price increases are driven by temporary factors, short-term demand, speculation, or limited supply of shares. Without understanding the cause, it's easy to mistake momentum for stability, and that can lead to overconfidence. There is also a behavioral risk. Once a framework starts working, it becomes tempting to apply it everywhere, to assume that every rising asset is worth attention, or that every falling asset should be avoided. But reality is more complex. Some declining businesses recover. Some rising businesses fade. The goal is not to follow rules blindly, but to apply them with context. This is where discipline becomes more important than strategy. Not reacting to every movement, not forcing decisions, and not assuming that one approach fits all situations. It's also important to recognize uncertainty. No analysis can remove it. No pattern eliminates it. The best that can be done is to make decisions that are reasonable given the available information, and to remain open to updating those decisions when new information appears. In the final part, we bring everything together into a simple mental model, not something to memorize, but something to return to when the market feels unclear. When markets feel uncertain, most people search for answers in prices. They look for what has fallen the most or what seems cheapest compared to before. But price is only the surface, and relying on it alone often leads to the same cycle: buying weakness too early, holding too long, and hoping things return to where they used to be. A more useful way to think about the market is much simpler. Focus less on where something was and more on where it is going. There are 3 questions that can help anchor that thinking. Is the business improving, staying the same, or weakening? Is it performing better or worse than others in its space? And is the current price reflecting realistic expectations or stretched ones? These questions don't require perfect answers, but they shift attention toward what actually drives outcomes over time: direction, positioning, and underlying performance. It also helps separate 2 ideas that are often confused: a good company and a good investment. They are not always the same at the same time. A strong business can still be overpriced. A struggling business can still look cheap for a reason. The goal is not to predict every move. It's to avoid decisions that rely on assumptions instead of evidence. This is where many experienced investors tend to converge over time, not on specific strategies, but on a mindset. Avoid unnecessary complexity. Pay attention to what is actually happening, and stay patient when the picture is unclear. Because in the long run, results are not driven by a single decision. They are shaped by a series of small choices. How risk is handled, how uncertainty is approached, and how discipline is maintained when emotions rise. Markets will always create noise. There will always be reasons to feel urgent, and there will always be stories that sound convincing, but most of them fade. What remains are the underlying businesses and the decisions made around them. So instead of asking, what should be bought right now, a better question might be, what kind of thinking leads to better decisions over time? If this perspective was useful, consider staying with the channel. The focus here is not on predictions or quick wins. It's on understanding how decisions are made and how they compound over time. Because in the end, the way someone thinks about investing matters far more than any single idea. And that's the useful content we wanted to share with our beloved viewers today. If you found it interesting and helpful, don't forget to like and subscribe to the channel to help this content reach more people. Now goodbye, and see you in the next video.